Hi, I'm Gaurav Singh. I'm a real estate agent, an avid reader, and someone who's passionate about long-term investing. When I first started investing, I remember constantly worrying, what if I buy at the top? What if the market crashes right after I invest? If you've ever felt the same, you're not alone. And right now, with the US stock market near record highs, the question on everyone's mind is the same. Are we in a bubble? In this video, I'll break it all down. We'll revisit past crashes, look at where the market stands today, dive into key valuation indicators, and discuss the signals that might hint at what's coming next. By the end, you'll have a clear picture of what's really going on and how to think about investing when markets feel risky. Before we talk about today, let's take a quick look back. In 1929, speculation ran wild. Banks failed and the market fell by 80%. It took years to recover, but it did. In 1987, stocks fell 22% in a single day, the worst one-day drop in the history. But within 2 years, the market was back at an all-time high. In 2000, during the dot-com bubble, investors believed every internet company would change the world. Prices soared far beyond reality, and when earnings couldn't keep up, the Nasdaq crashed 78%. Then came 2008. The housing bubble burst. Banks were over-leveraged and the credit system froze. The market fell hard but eventually came back. Even in 2020, when COVID shut down the global economy, stocks plunged and then staged one of the fastest recoveries in the history thanks to government stimulus. The takeaway is simple. Markets crash, but they recover. Trying to perfectly time every top and bottom is nearly impossible, and long-term investors are usually better off staying focused on owning great businesses. Now let's come back to today. The S&P 500, which is basically a basket of America's 500 biggest companies, is near record highs. But here's what's unusual. Just 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, make up over 30% of the entire index. Think about that. Out of 500 companies, 7 are carrying almost a third of the market. That level of concentration makes some investors nervous because when so much depends on so few, risks rise. And that's not the only concern. Years of cheap money, sky-high valuations, and massive bets on AI have led some people to call this an everything bubble. But others argue the time is different. These companies dominate globally, generate record profits, and AI could bring productivity gains unlike anything we've seen before. So who's right? To answer that, we need to dive into the numbers. Let's talk about 4 key indicators experts use to judge whether the stock market is overvalued and what they're telling us right now. The first is the Buffett Indicator, named after Warren Buffett. It compares the total value of the US stock market to the size of the US economy. Historically, anything above 120% signals the market is expensive. Right now, this number is around 200%. That's higher than it was during the dot-com bubble, which peaked at around 150%. You can track this live on websites like buffettindicator.net. Historically, the Buffett Indicator has been an early warning sign. In 2000, it was flashing red before Nasdaq collapsed, and in 2008, it was elevated again before the housing market crash. But it's not perfect. US companies now make a significant chunk of their profits overseas, so comparing their global earnings to just the US GDP can make valuations look more extreme than they actually are. Next, we have the PE ratio, or price to earnings ratio. It tells you how much investors are willing to pay for every dollar a company earns. Imagine buying a lemonade stand that makes $1 a year. If you paid $20 for it, your PE is 20. Historically, the S&P 500's average PE has been around 15. Today, it's closer to 20. Before the dot-com crash, PEs went above 40, and before the 2008 crisis, they hovered around 23. But here's the catch. Today's businesses are more profitable and more efficient than they were decades ago. So slightly higher PEs can sometimes be justified. And then there is the PEG ratio, which adjusts the PE ratio for earnings growth. It asks a simple question. How much am I paying today for the company's future growth? A PEG of 1 usually signals fair value. Some AI-driven companies surprisingly look reasonable here because analysts expect their earnings to grow very quickly. You can track PEG ratios on Y charts. Historically, PEG has also been useful. Before the dot-com bubble burst, PEG exploded to 4.0 and above, which showed growth expectations were way out of control. The flaw here is that PEG depends on analyst forecasts, and if those forecasts are wrong, the metric collapses. Finally, there's the CAPE ratio, also known as the Shiller PE. It smooths earning over the last 10 years to avoid being misled by any temporary booms or busts. Historically, the CAPE ratio averages to around 17. Today, it's hovering around 39. CAPE has a strong track record. It was elevated before the 1929 crash, hit record highs before 2000 bubble burst, and was elevated again before the 2008 crash. But it also has its flaws. Because of stock buybacks and accounting rule changes, comparing CAPE directly across decades isn't always accurate. So, what do all of these metrics tell us? The market is expensive, there's no denying that. But expensive doesn't automatically mean we're about to crash. Markets can stay expensive for years if earnings keep growing. Here's an important point. High valuations don't cause crashes on their own. There's always a trigger. In 2008, it was a housing bubble colliding with a credit freeze. In 2000, it was internet hype outrunning actual earnings. In 2020, it was a global pandemic. Crashes happen when stretched valuations meet a shock. Until that shock comes, markets can defy gravity longer than most people expect. Even though we can't predict the exact timing of a crash, there are warning signals worth watching. One of them is market breadth. If fewer and fewer stocks are driving most of the gains, like the Magnificent Seven today, the market becomes fragile. Another key signal is called the VIX, which is known as Wall Street's Fear Index. Think of the VIX as a real-time measure of how nervous investors are about the next 30 days. When the VIX is low, traders are relaxed. But when it spikes sharply, it often means fear is spreading fast and volatility usually follows. Finally, pay attention to credit spreads. When borrowing suddenly becomes more expensive for companies, it often spills into the stock market. None of these signals are perfect on their own, but when several flash red together, the probability of a correction rises. Right now, the debate is intense. The bulls believe AI could drive massive productivity gains, big tech's profits are resilient, and moderating inflation could push the Federal Reserve to pause or even cut interest rates. The bears argue valuations are dangerously high. Market leadership is too narrow, and if credit tightens suddenly, stocks could fall hard. The truth probably lies somewhere in the middle. So, is the US stock market in a bubble? In certain corners, especially AI and tech, yes, things look frothy. But a full-blown mania? Not yet. Here's why I say that. In past manias like the dot-com bubble, people were throwing money at anything with a dot-com in its name, even if the company had no profits, no product, and no plan. Today it's different. The big winners, companies like Nvidia, Microsoft, and Google, are actually making enormous profits and dominating their industries. Back then, retail investors flooded the market, borrowing heavily to chase quick gains. Today, retail participation is higher than average, but institutions and real earnings are still driving most of the rally. In other words, there's hype, but there's also substance. Now that doesn't mean the risk isn't real. If earnings disappoint or liquidity dries up, things can change fast. But we're not yet at the level where speculation replaces fundamentals across the board. Here's what I remind myself. You don't need to predict every crash to build wealth. Focus on owning great businesses, diversify, and stick to a process you trust. Because if history has taught us anything, it's this. Missing just a handful of the market's best days often means missing the recovery. And recoveries always come. If you want more videos where I break down investing, trading, and market insights in plain English, then subscribe to the channel and I'll see you in the next one.